Ever hear someone say stocks just go up over time? Well, it's not that simple. Markets move in cycles, and understanding these cycles is the key to navigating them. Think of it like seasons. Prices don't just react to today's news. They're constantly looking ahead, pricing in future expectations for growth and inflation. Today, we're going to break down the entire equity cycle, from the bottom to the top, into 4 repeatable phases: despair, hope, growth, and optimism. The secret is that what drives returns changes completely from one phase to the next. Let's start at the bottom, in the despair phase. This is when the market is falling. Economic news is bad, headlines are scary, and investor expectations are being crushed. Volatility spikes, and valuations get hammered down. It feels like the pain will never end. On average, this phase lasts about 16 months, and historically, it's seen markets fall by over 40%. It's a brutal time. But then, something shifts. The cycle moves into the hope phase. This is the most counterintuitive part. The real economy often still looks terrible, unemployment might still be rising, and companies are reporting weak earnings. But the market suddenly springs back to life. Why? Because investors start to see a light at the end of the tunnel. They begin pricing in a better future, even if it hasn't arrived yet. The rate of bad news starts to slow down. This rebound isn't driven by actual earnings. It's almost entirely driven by psychology, what we call multiple expansion. Investors are willing to pay more for every dollar of future earnings. The hope phase is usually short, maybe around 9 months, but it's incredibly powerful. It's often the strongest part of the entire cycle, with average returns of over 40%. It's the market prepaying for the recovery it sees coming. Next, we enter the growth phase. This is the longest part of the cycle, often lasting for years or more. Now, the economy has finally caught up to the market's optimism. Earnings are actually growing, and it's a strong, steady period for businesses. You'd think this would be the best time for stock returns, right? But surprisingly, returns can be just okay, maybe around 16% total during this long stretch. Why? Because the valuation expansion we saw in the hope phase often stops or even reverses. The market already priced in a lot of this good news. So while earnings are doing the heavy lifting, the PE multiples might actually shrink a bit, acting as a headwind. This phase builds the foundation for future returns rather than delivering immediate fireworks. Finally, we arrive at the optimism phase. Confidence turns into complacency, and maybe even a little bit of greed. Everyone feels like a genius. The market surges again, but this time, it's not really backed by fundamental earnings growth. Valuations climb much faster than profits, driven by pure sentiment. This phase can deliver spectacular returns, sometimes over 60% in a couple of years. But it's also where the seeds of the next downturn are sown. Volatility starts to creep up as people begin to question how long the party can last. This sets the stage for the cycle to begin all over again with the next phase of despair. So, to recap the numbers from US data since the 70s, despair sees prices fall about 43%. Hope brings a sharp 44% rebound. Growth delivers a steady but slower 16%. And optimism rockets up 62% before the fall. The key takeaway is that the best time to invest is often when things feel the worst but are just starting to get less bad. We can even see these cycles play out in a smaller way, what we call mini-cycles. If you look at monthly economic surveys like the ISM, you'll see this pattern repeat. The best stock returns happen when the ISM is low, below 50, but has started to turn upward. The worst returns when the ISM is low and still falling. Now, let's bring in another crucial player: bond yields. The relationship between stocks and bonds is not static. It changes depending on where we are in the cycle. Generally, falling bond yields are good for stocks because it makes them relatively more attractive. But it's nuanced. Sometimes, rising rates can happen alongside strong equity returns if it signals a healthy, growing economy. The shape of the yield curve is also a huge tell. A steepening curve where long-term rates are higher than short-term rates usually means policy is supportive and a recovery is underway. An inverted curve, the opposite, has famously been a warning sign for recessions. But what about other assets? The cycle doesn't just affect stocks. Let's build a full cross-asset playbook. During recessions, in the despair phase, defensive assets are your friend. High-quality government bonds and gold tend to hold up much better while equities suffer. Then, as we enter the hope phase, the leadership flips dramatically. Equities take off, often leaving bonds and gold in the dust. Later in the expansion, during the growth phase, equities are still strong, but this is where commodities often shine. They react to the realized demand from a humming global economy. Then, as we move back toward a downturn, leadership shifts back toward defensives. The big wild card in all of this is inflation. High and rising inflation is a nightmare scenario. It's often bad for both stocks and bonds. It pushes bond yields up, which hurts bond prices. And for stocks, it compresses valuation multiples and can squeeze company profit margins. This is when the classic 60/40 portfolio can fail you, as both asset classes fall together. We saw this during the stagflation of the 1970s. In these environments, commodities can become a crucial diversifier. Let's talk about why this all works. The price of a stock is simply the present value of all its future cash flows. That calculation involves two key things: the earnings themselves and the discount rate used to value them. That discount rate is heavily influenced by bond yields. So, when bond yields fall, the discount rate falls. And all else being equal, stock prices should rise. But all else is rarely equal. If yields are falling because the economy is collapsing and earnings expectations are plummeting, then stocks will fall too. This is why the relationship between stocks and bonds changes over time. For a long time after the 2008 financial crisis, we were in a world where falling yields signaled economic weakness, so stocks and bonds moved in opposite directions. But this isn't always the case. The actual level of yields matters too. When yields are very low, say below 4%, rising yields can actually be good for stocks because it signals confidence is returning to the economy. So when you see bond yields rising, don't just assume it's bad for stocks. You have to ask a few questions. Where are we in the economic cycle? How fast are yields rising? What level did they start from? And is the rise being driven by real economic growth or by inflation fears? Ultimately, understanding these cycles isn't about predicting the next data point or news headline. It's about recognizing which phase we're in and understanding the forces that are likely to drive returns in that environment. It's about identifying the inflection points, those crucial moments when the trend is about to turn, positioning yourself for the part of the cycle where the market tends to reward you the most. By thinking in terms of these four phases, you can build a much more robust and dynamic framework for your investments. Thanks for watching. If you found this breakdown helpful, be sure to like this video and subscribe to the channel for more insights into how markets really work. See you next time.